Why gold goes up when the war gets worse. Ray Dalio finally explains it. I want to start with something that happened on March 26, 2026. Iran rejected the American ceasefire proposal completely. No negotiation, no counteroffer, just rejection. And then Iran fired another round of missiles at Israel. The war got worse, meaningfully worse. And gold fell $126 in a single day. Let me say that again because I want it to land. The war got worse and gold went down. If you own gold right now, I know exactly what you are feeling. You bought gold because the world was supposed to be on fire and gold was supposed to protect you. And the world is on fire. Bombs are falling across the Middle East. The Strait of Hormuz has been effectively closed since March 4th. The OECD raised its U.S. inflation forecast to 4.2% for 2026 on March 26th. The national debt just passed $39 trillion, and gold is trading around $4,211, down from $5,595 at its peak in late February, down almost 21% while the war escalates. You did everything right, and it feels like the market is punishing you for it. I want to tell you something very clearly. You are not wrong about gold. You are just watching the wrong signal. And by the end of this video, you will understand exactly why gold falls when the war gets worse, and exactly why that is the most important buying signal in 50 years of precious metals markets. I have been studying how gold moves during geopolitical crises since 1973. I watched gold fall during the Gulf War. I watched it fall after September 11th. I watched it fall during the Ukraine invasion. And every single time, the investors who sold at the bottom because they could not understand why gold was falling when everything was supposed to be bullish for gold missed the most significant moves in precious metals history. Today, I am going to show you the mechanism, the exact reason why gold falls when war escalates, why that mechanism is temporary, and why when it reverses, which it always reverses, the structural conditions in 2026 make what comes next larger than anything I have seen in 5 decades. Subscribe now and turn on the notification bell before we go further, because what I am about to show you is the framework that changes how you read every gold headline you will ever see again. Here is the question that nobody in financial media is answering clearly. Why does gold fall when the war gets worse? It seems completely backwards. Every financial advisor you have ever spoken to told you gold is the safe haven, the financial bomb shelter, the thing you buy when the world is burning. So why on March 26th, when Iran rejected the American peace plan and fired missiles across the Middle East, and analysts were calling this the most dangerous phase of the conflict, did gold drop $126 in a single session? The answer is a mechanical sequence. Write this down because once you understand it, you will never be confused by a gold headline again. Step 1. Geopolitical escalation creates an oil shock. Iran's effective closure of the Strait of Hormuz starting March 4th drove Brent crude from $65 before the war to above $112 per barrel by mid-March. That is a 72% spike in oil prices in less than 4 weeks, the largest energy supply disruption since the 1973 OPEC embargo. Step 2. The oil spike drives inflation expectations higher, not actual measured inflation yet, expectations. And expectations matter as much as reality to financial markets. The OECD confirmed this on March 26th when it raised its 2026 U.S. inflation forecast to 4.2% annually. When traders price in that number, they act immediately. Step 3. Elevated inflation expectations prevent the Federal Reserve from cutting rates. Before the Iran war began on February 28th, rate cuts were a live conversation for 2026. That conversation ended the moment oil crossed $100. Fed funds futures as of late March show virtually zero probability of any cut before late 2026 at the absolute earliest. The Fed is frozen. Step 4, a frozen Fed means bond yields stay elevated or move higher. The 10-year Treasury yield is sitting at 4.39%. That is a guaranteed 4.39% annual return on the most liquid, most creditworthy instrument on earth. Zero storage costs, zero volatility risk, zero counterparty risk, 4.39% per year guaranteed from the full faith and credit of the United States government. Step 5. When a Treasury bond pays 4.39% with no risk and gold pays zero, institutional capital does the math. Some of it rotates out of gold into Treasury bonds. This is not sentiment, this is arithmetic. And institutions manage trillions of dollars by doing arithmetic, not by following their gut. Step 6. Simultaneously, global investors seeking safety buy U.S. Treasury bonds. That demand for dollar-denominated assets strengthens the dollar. The dollar index moved above 100 in mid-March. A stronger dollar mechanically suppresses the dollar price of gold because gold is priced in dollars. When the dollar strengthens, it takes fewer dollars to buy an ounce of gold, which means the price in dollars falls. 3 headwinds hitting gold simultaneously. Oil drives inflation expectations. Inflation expectations freeze the Fed. A frozen Fed keeps yields high. High yields create opportunity cost against gold. Simultaneously, safe haven demand flows into dollar-denominated assets. Dollar strengthens, gold price in dollars falls. All 3 caused by the same war that everyone told you was bullish for gold. This is why your gold is down 21% from its peak while the world burns. And this is why gold has always been red for a period during every single major geopolitical crisis I have watched in 50 years, without exception, every single time. Now here is the part that changes everything. This mechanical suppression does not last. It has never lasted. And the historical record of what happens after it exhausts itself is the most important data set for every gold investor alive right now. Let me walk you through it because the pattern is not an opinion, it is documented history. 1973, OPEC cuts oil production and slaps an embargo on the United States. Oil quadruples from $3 to $12 a barrel, the largest supply shock in the history of the global energy market at that time. What does gold do immediately? It falls. Then over the following 2 years, gold rises 150%. And when you zoom out to the full arc of the oil inflation disaster from 1971 to 1980, gold rose 2,300%. That is not a typo, 2,300%, from $35 per ounce in 1971 to $850 per ounce in 1980. The investors who sold in the initial confusion locked in small losses. The investors who held, or better yet, accumulated during the confusion, captured one of the greatest wealth transfers in financial history. 1979, the Iranian Revolution, the Shah falls, oil production collapses, prices spike to levels that seemed unthinkable. Gold does very little immediately, confusing, concerning, exactly like the pattern we are watching in March 2026. Then over the following 12 months, gold rises 89%. And in the year after that, it rises another 10% from an already elevated base. The total move from the 1979 oil shock to the 1980 peak was extraordinary. And it started with a period of exactly the kind of confusion that gold investors are experiencing right now. 1990, the Gulf War. Iraq invades Kuwait. Oil spikes sharply. Gold pops roughly 10% initially and then gives back the entire move. Investors who sold in the confusion and declared gold broken missed the broader bull market that followed throughout the 1990s. Defense stocks and energy stocks outperform in the immediate term. Gold consolidates. And then the structural move comes. 2001, after September 11th, markets crash, fear is everywhere. Gold does nothing dramatic in the immediate aftermath. Most investors are confused. How is gold not spiking during the worst attack on American soil in history? And then gold begins a decade-long bull run from $250 per ounce to $1,900. That is a 660% move over 10 years, starting from the exact moment when most investors were most confused about why gold was not responding the way they expected. 2022, Russia invades Ukraine in February. Oil spikes. Gold breaks $2,000 per ounce for the first time in history. New all-time highs. Sustained outperformance throughout the year, even as yields rose and the dollar strengthened. Every major oil shock in the last 50 years, followed by significant gold outperformance after the initial mechanical suppression period exhausted itself, not because of luck, not because of coincidence, because the mechanism that temporarily suppresses gold during a shock always eventually reverses. And when it reverses, the structural case for gold reasserts itself with full force. Now, here is what I need you to understand about 2026 specifically, because what makes this moment categorically different from every previous cycle is not the war. It is the structural conditions that the war landed on top of. And those conditions are more extreme than anything I have seen in 5 decades. In 1973, the United States national debt was approximately $500 billion. Today, it is $39 trillion. That is not a larger version of the same thing. That is a fundamentally different fiscal reality. A country with $500 billion in debt can raise interest rates to 20% to fight inflation. Paul Volcker did exactly that in 1979, and it broke the inflationary cycle. A country with $39 trillion in debt paying $103 trillion annually in interest cannot raise rates to 20%. The arithmetic does not permit it, which means the inflation that this oil shock is embedding into the system cannot be addressed through the same mechanism that resolved the 1970s version. The Fed is trapped in a way it has never been trapped before in its history. In 1973, central banks were net sellers of gold. Today, central banks are expected to purchase approximately 755 tons of gold in 2026 alone, significantly elevated compared to pre-2022 averages of 400 to 500 tons annually. 3 consecutive years of central bank gold purchases above historical averages, followed by continued elevated buying. This is not diversification. This is strategic repositioning at a scale the gold market has never experienced before in its entire history. Central banks are not buying gold because they think the price will go up next quarter. They buy on a decade-long time horizon, and they have been consistent net buyers for 3 consecutive years through every period of price volatility, including the current one. In 1973, the geopolitical realignment underway was smaller and slower. Today, the selective closure of the Strait of Hormuz, where Iran allows ships from India, China, and Russia to pass while blocking Western allied vessels, is an active demonstration that the global monetary architecture is being contested at the most fundamental level. Iran is not just disrupting oil supply. Iran is showing every emerging market government on the planet that energy trade can be settled outside the dollar system, and the governments watching this demonstration are drawing exactly the conclusions you would draw if you were in their position. In 1973, there was no silver supply deficit. The silver market entering 2026 is navigating its 5th consecutive year of industrial consumption outpacing mine supply, 5 consecutive years of structural deficit, 5 years of inventory drawdown, 5 years of a supply-demand imbalance that cannot be fixed quickly because silver mine supply is largely a byproduct of copper, lead, and zinc mining. You cannot simply decide to produce more silver in response to a price signal. The production timeline for a new silver mine from discovery to output is a decade or more. In 1973, industrial demand for silver was a fraction of what it is today. Today, silver goes into every solar panel manufactured anywhere on Earth. Every electric vehicle requires 60 to 80 grams of silver compared to 15 to 20 grams in a conventional car. Every AI data center requires silver in its cooling and electrical systems. Every defense electronic system, every satellite communications platform, every semiconductor fab. The industrial demand base that underpins silver's price in 2026 is structurally larger, structurally more inelastic, and structurally less replaceable than anything that existed in any previous geopolitical cycle. Every structural condition in 2026 is more extreme than in 1973. Every structural driver is more powerful. And the mechanical suppression that is currently holding gold at $4,411 when JP Morgan's 2026 year-end target is $6,300, when Wells Fargo's target is $6,100 to $6,300, when UBS's target is $6,200 by September 2026, is temporary. That gap between where gold is trading right now and where the most sophisticated institutional forecasters on Earth say it is going is exactly what I mean when I say what comes next is going to be the most significant move in precious metals in 50 years. Now, let me walk you through the four-phase recovery pattern because understanding which phase we are in right now changes everything about what you should do with that information. Phase 1, the panic phase. This is typically the first 1 to 4 weeks of a major geopolitical shock. Oil spikes, gold spikes initially, then drops hard as the mechanical sequence I described takes hold. Financial media runs 24-hour coverage with dramatic graphics designed to maximize anxiety. Most retail investors do one of two things. They panic sell at the bottom of the initial drop, or they panic buy gold at the absolute top of the initial spike. Both decisions are typically wrong. The initial spike from roughly 5,100 to 5,595 in the first days of the Iran war on February 28th was the retail panic spike. The drop from $5,595 back to $4,411 is the mechanical suppression phase. Phase 1 in the pattern I have watched play out after every major oil shock. What are institutions doing in phase 1? Watching patiently. They have seen this movie before. They are not doing anything dramatic. They are studying the structural conditions. They are calculating the trajectory of yields and the dollar, and they are waiting for the signals that tell them when phase 2 is exhausting itself. Phase 2, the absorption phase. Typically month 2 to month 3 of the crisis, the initial panic subsides, the fear index comes down slightly, gold pulls back from its initial spike, sometimes significantly. Silver falls more, typically 15% to 20% or more from its peak. This is where the largest number of individual investors make their most expensive decision. They look at their portfolio, they see red, they read a headline saying, gold has failed as a safe haven, and they sell. In 50 years of watching markets, I have seen this happen after every single major crisis. And in every case, it was the worst possible moment to sell. Not because I am always right about what comes next, but because phase 2 is almost always the bottom. And selling at the bottom is how investors lock in losses permanently rather than participating in recoveries that follow. Where are we right now in late March 2026? Based on the timeline of the Iran war, which began on February 28th, and the price action I have been observing, I believe we are somewhere in the transition between phase 1 and phase 2. The initial panic spike has occurred and been fully reversed. The forced institutional liquidation from margin calls is in the process of exhausting itself. The structural buyers, central banks, long-term institutional allocators, physical gold buyers in Asia are beginning to accumulate at these levels. The confusion is at its peak. which historically has meant the opportunity is also at its peak. Phase 3, the structural bid phase, typically month 4 through month 18 of a crisis cycle. The broad market begins stabilizing. The panic-driven institutional selling that depressed gold in phases 1 and 2 exhausts itself. The structural buyers begin to dominate price action. Central banks, who have been buying through the volatility without interruption, continue to accumulate. Institutional investors rebalancing into real assets begin to increase allocations. Retail investors who are finally psychologically comfortable enough to re-enter begin accumulating. Gold finds a genuine bid, not the panic bid from phase 1. The structural bid backed by the forces that have been building throughout the suppression period. Central bank buying, supply deficits in silver, the debt dynamics that make monetary debasement an eventual mathematical inevitability. Miners begin leveraging up on improving prices. Energy infrastructure stocks rally as oil supply disruptions are priced into the medium-term outlook. And most retail investors are sitting on the sidelines, having sold in phase 2, too scared to re-enter, watching gold make new highs and telling themselves they will wait for a pullback that may never come at a price they recognize as attractive. Phase 4, new all-time highs, typically month 12 onwards, sometimes extending 2 to 3 years. This is what the historical record shows after every major oil shock without exception. 1979 to 1980, new all-time highs that seemed impossible to most observers until they happened. Post-September 2001, new all-time highs sustained for a decade. Post-2022, Ukraine invasion, new all-time highs that broke records that had stood for years. The mechanism is always the same. The oil shock embeds inflation. The inflation forces the Fed to keep rates elevated for longer than the economy can comfortably sustain. Eventually, the debt arithmetic, the cost of servicing $39 trillion at 4% to 5% annually, overwhelms the inflation-fighting mandate. Rates come down. The dollar weakens. The 3 headwinds I described in the first part of this video reverse simultaneously. And gold responds to all 3 tailwinds at once, moving faster than most investors expect and moving further than most models predicted. Now, let me address something that I think is the most important insight I can give you about silver specifically, because silver's story in this cycle is different from gold's, and it is different in a way that most investors do not fully understand. Gold tends to lead the initial phase of these cycles, responding to sovereign and monetary drivers. Silver initially lags, but silver moves with greater intensity once the structural momentum begins. This dynamic, where silver trails gold on the initial breakout but moves with higher velocity, creates a natural expansion and contraction in the gold-silver ratio that sophisticated investors use to position themselves. In the 1979 cycle, silver did not just follow gold. It massively outperformed gold. Gold rose approximately 276% from the Iranian Revolution to its 1980 peak. Silver rose from roughly $5 to $50 per ounce, a tenfold increase, 10 times. Gold did 276% and silver did 900%. The reason is that silver is both a monetary metal and an industrial metal. In a crisis, the monetary properties drive the initial move. But as the crisis embeds into the economic system, the industrial properties add a second engine that gold simply does not have. In 2026, that second engine is more powerful than in any previous cycle. Solar panel installations worldwide require silver as a conductor in amounts that cannot be replaced by any cheaper alternative at current silver price levels. The cost of the silver in a solar panel is a small fraction of the total system cost, which means demand is inelastic to price at current levels. Electric vehicle production requires 60 to 80 grams of silver per vehicle, compared to 15 to 20 grams in a conventional car. AI data center infrastructure, defense electronics, satellite communications, all of these sectors require silver in applications where substitution would cause significant performance degradation. And then there is the supply constraint. 5 consecutive years of market deficit, mine supply that cannot respond quickly to price signals because production is driven by the economics of base metals, not silver. China, which controls approximately 60% of global silver refining capacity, has been restricting silver exports as a strategic material. When the monetary bid returns to silver in phase 3 of this cycle, the industrial demand that has been running continuously throughout the crisis will add to it rather than subtract from it. That combination is what produces silver's characteristic pattern of lagging gold into the move and then dramatically overtaking it. Let me close with the 2 specific indicators I am personally watching to identify when the transition from phase 2 to phase 3 has fully arrived. These 2 numbers are the only ones that matter. Everything else is noise. The first is the US dollar index, currently elevated above 99 due to the petrodollar demand surge created by the oil shock and safe haven flows. When the DXY falls back below approximately 97, the primary mechanical headwind on gold prices begins to diminish meaningfully. This will happen when oil prices stabilize, when alternative supply routes through Saudi pipelines and Emirati bypass infrastructure absorb enough of the Hormuz disruption to reduce emergency dollar demand, or when some form of diplomatic framework begins to create expectations of de-escalation. Watch the dollar index, not the war headlines. The second is the 10-year Treasury yield, currently at 4.39%. When this falls back below 3.5%, the opportunity cost argument against holding gold weakens to the point where institutional rotation out of Treasury bonds and back into gold becomes mechanically favorable on a large scale. This will happen when the Federal Reserve begins cutting rates, which will happen when the debt arithmetic of $39 trillion at 4% to 5% makes it impossible to continue without causing a fiscal crisis more severe than the inflation risk the Fed was trying to prevent. That moment is not far away. The Fed cannot pay $1.03 trillion annually in debt service indefinitely at current debt growth rates. The arithmetic has only one resolution. These 2 indicators will tell you when the mechanical suppression is exhausting itself. The war news will not tell you. The daily oil headlines will not tell you. The financial media's 24-hour fear cycle will not tell you. Watch the dollar, watch the yield. Those 2 numbers contain everything you need to know about when phase 3 begins. Wells Fargo Investment Institute lifted its 2026 gold target to $6,100 to $6,300 per ounce in March 2026. JP Morgan forecasts $6,300 by year-end 2026. UBS raised its target to $6,200 by September 2026. Ed Yardeni, after adjusting his near-term forecast to $5,000, is holding his end-of-decade target at $10,000 per ounce. These are not the wishes of retail investors who bought gold and need the price to go up to feel validated. These are the research departments of the institutions that collectively manage more capital than any other entities on Earth. They are not issuing these targets because they believe the mechanical suppression currently holding gold at 4,411 is permanent. They are issuing them because they have done the structural analysis of central bank buying, supply deficits, debt dynamics, and rate trajectory that tells them the current suppression is temporary. And they have calculated the size of the move that follows when it reverses. There are two types of investors watching gold trade at $4,411 in late March 2026. The first type sees gold down 21% from its peak while the war is still escalating and concludes that the trade is broken. Gold failed. It did not do what it was supposed to do. They sell. They move into something that feels safer. And 12 months from now, when gold is making new all-time highs, they will say they knew they should have held, but they will not hold, because by the time gold is at new highs, they will be telling themselves it has gone up too far and they will wait for a pullback. The pullback will come in the form of another phase 1 or phase 2, another moment of maximum confusion, and they will sell again. The second type looks at the same 4,411 price and thinks something very different. They think phase 2, mechanical suppression, the same sequence that is played out after every major oil shock in 50 years. They think central banks are buying at these levels. They think JP Morgan and Wells Fargo and UBS have done the structural analysis and arrived at $6,100 to $6,300 as their year-end target. They think the gap between $4,411 and $6,300 is not random. It is the calculated distance between where the mechanical suppression holds the price today and where the structural conditions say it is going when the suppression reverses. And they accumulate quietly, patiently, without drama, while the phase 2 noise is at its absolute loudest. I have watched both types of investors across every major crisis of the last 50 years. I know which type builds generational wealth, and I know which type watches it happen from the sidelines and calls it luck. The move that is coming in gold and silver when phase 3 begins is not unthinkable because it has never happened before. It has happened after every major oil shock in recorded history. It is unthinkable in size because the structural conditions underlying it in 2026 are more extreme than in any previous cycle. More debt, more central bank buying, more silver deficit, more industrial demand, more fiscal constraint on the Federal Reserve, more dollar pressure from a petrodollar system being actively challenged for the first time in 52 years. Watch the dollar. When it falls below 97, you will know the suppression is beginning to break. Watch the 10-year yield. When it falls below 3.5%, you will know the institutional rotation is beginning. Everything else, the war headlines, the ceasefire rumors, the political theater, is noise designed to keep you emotional and reactive when the correct posture is patient and structural. The mechanism has played out the same way after every major oil shock in history. The structural conditions in 2026 are the most extreme ever observed, and the institutional price targets are already telling you where the math leads. Two numbers: dollar below 97, yield below 3.5. Everything else is noise. That is the framework. That is what I have spent 50 years developing. And that is what the confused investor who just watched gold fall on the day Iran rejected the American peace proposal needs to understand before they make the most expensive mistake of the next decade.